Hi, my name is Manish Bajpayee, and in this talk, I would present a critique of technical analysis in view of efficient market hypothesis. Uh, so, the context is that a lot of investors believe that technical analysis can help them enhance their returns. It can help them predict the market. Whereas efficient market hypothesis doubts this wisdom. So who is right? And if you're an investor, should you even bother about technical analysis, or should you just ignore all of it in light of efficient market hypothesis? That's the question I'm trying to address and discuss in this talk. So first of all, a little bit wider review of the two concepts. Technical analysis primarily concerns itself with the past information. This information could be the pricing of a stock or index, and it could also include other things like volume. And there you could mutate this data in various ways, and you could try to discern trends of a stock or an index from this data. One way of putting it is that the technical analysts believe that the past data has a key to the future performance. For many of them tend to look at the charts or some visual representation of this data. So they're also called chartists, but that's just a jargon. The underlying theory is that by looking at the past performance of a stock, you can predict its future movement. For example, if a stock, a very trivial analysis could be that you look at the chart, and if you see that a stock is going down and the volume is increasing, this means that there's a downward momentum, and so you should sell the stock, and that this should be a profitable strategy. However, the efficient market hypothesis at its simplest claims that you cannot use the past information to predict the future. The stock market pricing already has all the past information built into it in terms of the pricing. So, for example, if Microsoft share is trading currently at, let's say, $30, then this current price itself is a reflection of all the past knowledge about Microsoft, and any price change in future will have nothing to do with the past information. It'll happen only in response to the new information, and only that new information which is unpredictable. Because if something is predictable, for example, if Microsoft has announced that it is going to give a dividend every quarter, those future quarter dividends are already part of the known information, and hence the part of the price, and hence they will play no role in the future price movement of Microsoft. So these two, as you can see, are pretty contradictory in nature. Efficient market hypothesis, people seldom quote really good studies to say that uh, uh, the stock prices actually move in a random fashion. They follow something called a random walk. So you cannot say which way they're going to move. It's like the walk of a drunk man who is so drunk that he doesn't know where he's going to step next. So I think that for any intelligent investor, it's really crucial to understand that there is solid theory behind efficient market hypothesis, at least the semi-weak form, which is what we are concerned here with mostly. And there's not so much of a theoretical evidence in support of technical analysis. So those of you who believe in theory, you should probably not put much credence in technical analysis, and yet there are a lot of people, lots and lots of investors who vouch that they believe in technical analysis, and some seem to have made a fortune. So what might be going on here? And should you really spend your thousands of dollars on buying the latest cool technical analysis software? Well, I think the short answer is to the last question is no, you shouldn't. And the long answer is that yes, it is possible for some people to make money using technical analysis, because I think that the future pricing of stock is not just a function of efficient market hypothesis. It is also a function of sentiments. The same information could produce different reactions from the investor class in different settings. In a period of bull markets, for example, any positive news would get reflected in the stock prices in an amplified manner. And in a bear market, even good news would probably not move the stocks as much. So it is not correct to say, or rather, it's fair to say that even though all the past information is built into the stock price, the future movement does not just depend on the news, on the new information. It also depends on how investors process that information, how bullish they are, how bearish they are. Do they really believe in the perpetuity of life, or do they think that the world is going to collapse? And technical analysis, to some extent, can help people with this kind of trend-based assessment. However, the reason that you probably cannot make money on this is also logically deductible. Suppose that there is a, and here's how I would argue my reasoning. Let's suppose that there is a technical analysis method which is so good that it really understands the psychology of people. It can really predict how people are going to react to good or bad news. And so potentially one could start trading on the news. Now, markets being what they are affected by the tradings. So assuming that more and more people start to understand this logic, more and more people would start to trade on this news. And this really happens very fast, just as efficient market hypothesis claims. So any new advances in technical analysis would actually become popular very fast. Even though you might think that you have never heard of it, that doesn't mean that it's not popular. Really, you and me are not the kind of people who have a sizable investment in the stock market or any other capital market for that matter. I think it's safe to assume that any new research or information about the psychological behavior would be known to a reasonable amount of people who, and so it'll have a reasonably decent effect on the stock market. So in the end, it'll be very difficult for anybody to really profit from that information. Sure, those people profited who went in with the first mover's advantage. For example, the people who wrote the software and used it in the beginning. But you would probably not likely to be one of those people. So I would say don't bet on technical analysis, but if it makes you feel good, by all means, give it a try and do it in a methodical way. Keep a track of how you're doing, and there are statistical tools that you can use to see whether your technical analysis tool of choice is performing any better than a random walk or not. And for God's sake, just do some analysis and see for yourself whether you are making right decisions or not. Thank you.